Hello and welcome to another episode of Monday Markets. As always, we are brought to you by Woo. Links available in the description below if you want to support the show. As always, they don't keep any more funds than necessary for trading with any centralized platform. The whole point of leverage is to allow you to reduce a counterparty risk. So let's talk about BTC. We are halfway through the monthly candle. Currently, we are trading above the 35k resistance, which is good. I think the close is going to be important. The reason the close is going to be important is because last month's close was below the level and acted as resistance. We're currently above previous month's high and above the level itself, which is positive. If this close gets stuffed in the second half of the month, resulting in a close below 35k, I think that would be quite bad on the monthly, or at least a sign of emerging weakness that the market was not accepted above the 35k range reclaim. Again, the larger argument here on the monthly, especially on the weekly, but also it's developing on the monthly as well, is that we have a large range between 58k and 35k. If you reclaim one side, you generally move towards the other side, and that argument only becomes available on the monthly time frame if we close and or hold above 35k. So last month didn't do that, but the weekly printed that signal. We've enjoyed the upside as a result of the weekly printing that signal, but it would be nice if the monthly were to fall in line and support that as well. You could also add a midpoint to that, as we've done before, with the mid-range at around 44 to 46k, depending exactly on how you draw the level. You could just cluster out this candle here, and I think you have a pretty accurate view of monthly and weekly resistance. So that's the high time frame chart for BTC, at least on the monthly time frame. One thing to recognize right now is that there is, based on a candle close basis, a tension between the monthly and the weekly timeframes. The weekly is unambiguously strong because it closed through its equivalent range low at 32k, but the monthly hasn't done so. And this month will likely decide whether it falls in line or not. So that tension is one of those timeframes is bluffing. Either the weekly bullish signal is bluffing, and this is a monthly bearish retest that's going to end up as a wick and trade lower, or the monthly time frame is bluffing in the fact that it's slow, and the weekly is sort of paving the way for bullish reclaim continuation, and the monthly is just being slow in catching up. At the moment, the weekly signal, the faster moving one, has been working out and paying. It would be nice if they fell in line with each other, so that there's no tension between those two timeframes. But really, for the next few months, I think this type of roadmap is very useful. If you wanted to add another level around the 30k breakout, I also think that's helpful. But realistically, I think if we fail below 35 and get stuff there on a monthly basis, a lot of these charts will start to look less positive. At that point, we will have had a big breakout, sort of stall at resistance and then trade back down. I don't think this would be particularly good support, but that view I think is also better expressed on the weekly time frame. Which brings us, of course, to the weekly time frame. As mentioned, there is a conflict between the monthly and the weekly, and the weekly looks unambiguously strong, following the close above 32.2, as we discussed on Monday Markets. I think there was a video titled "How Important is the Bitcoin Weekly Breakout?" This was the breakout candle. We had a week of essentially consolidation, and then another week of continuation. Now, in terms of which weekly levels could end up being interesting here, I don't really love any of them aside from the larger range midpoint, which, as discussed on the monthly time frame as well, sort of 44, 46, it's in that type of area. We could certainly start extrapolating and adding other levels that, not to cope per se, but certainly be accused of doing so. For example, this old range high at 38k is something rather nothing, but I don't really love any of those levels. They're not important enough compared to the others for decision making. So I still think on the weekly time frame, it looks good above 32.2k. If we're going to get volatility pullbacks or whatever, this should really hold. Even a decline from here to the weekly level, which would look quite bad, that would only be a 12% move, which isn't anything crazy. And even pulling back to the pre-breakout week, 2 weeks ago, would be a sort of 5-6% move. So those areas are interesting, but bigger picture contextually, if you're going to be a bear, I think it makes sense to either be bearish on another push into the sort of 44-46 midpoint, at which point you have the monthly and weekly on your side suggesting resistance, or back below 32k is a good spot to be bearish, because at that point the monthly and the weekly are aligned to the downside. So absent that, the monthly time frame resistance isn't doing a fantastic job of resisting yet, and the weekly bullish reclaim has done a decent job of being bullish. So I think it's neutral to bullish still until one of those signals falls in line with the other. I don't think there's anything else to add on the weekly time frame. I mean, realistically, 1, 2, 3, 4 weeks of green candles, one of which took us through this big macro reclaim level. And I don't really want to start looking for levels at 37, 38, 39, 40. I'm sure there's some decent daily time frame stuff there that could provide a reaction of some sort, but from a higher time frame swing point of view, there aren't any key decision points, I think, apart from 32 or mid-40s mid-range. Like, I'm sure there's something here if you try hard enough, but it's just not important enough on a swing basis to really shift the high time frames, I think. We're left with the daily time frame. This one is a bit trickier because what we essentially had was the impulse through the level, and then I quite like when the market forms this impulse consolidation impulse type of structure, and it's preferable when that consolidation structure takes place horizontally and you get a very clear range as opposed to sort of diagonally, which is what we have now. The diagonal stuff tends to make for weaker support and weaker resistance, or just kind of worse levels than the horizontal stuff. There are reasons for that. This is arguably sort of less efficient, as the price action traders call it, price action, but really there's just, you know, when you don't have a clearly defined range, there's less likely to be order herding and clusters of orders left around those levels, and it's just a bit messier when it's getting walked up. So that makes for, you know, diagonal support on average is weaker than horizontal support, especially when it comes to carving out a range. So that's something to bear in mind. If this starts to dip, I'll probably be quite conservative with levels to step in because I don't like buying sideways support. It looks okay at the moment. In the grand scheme of things anyway, like if it dips, obviously your first port of call, instead of waiting for the larger pullback to like 30k, if the market is strong, it really shouldn't be retesting those big breakout levels. So technically on the daily time frame, if this sort of red candle or the subsequent days accelerate, you ought to be looking, in my view at least, for support at more local levels, as low as the lows at around 33.8 for support, and as early, if it's really bullish, at around 35k. So this is a range of some sort. Again, it's a bit too diagonal in nature to be particularly high conviction, but I think it's the only appropriate level because anything deeper starts to threaten the whole breakout type structure. So in terms of stuff to look out for if we continue lower, I think 35 to 33.8 is 35.4 to 33.8 is a decent range. In terms of the price action right now, what we've currently had, and if it closes this way, it would be a sort of very short-term, not so great signal, was a kind of inside day failure. So this candle was the inside day because its price action was contained within the price action the preceding day. Technically, this was an inside day as well, but if we take the more recent one and mark out its high and low, then we've had a spike of previous day's high, and the close, which is in 5 hours or 6 hours rather, if that closes below previous day's low, then that's an inside day failure. So you spike one side, so failed breakout to the upside, and then if it closes below, real breakdown on the downside. That's at least a daily bearish pattern. It's not some sort of world-ending type of thing, and for all we know, just someone turns on the TWAP and it goes back up, so it's not, you know, particularly compelling. But just in terms of the technical structure here, a daily close below whatever yesterday's low is, 36.7 would be an inside day failure, and if you've been waiting for a dip, that'll probably be one of the better opportunities to wait for one, because at least the daily time frame will be turning at that point. So if that signal gets mitigated, like we close back above previous day's low, then I'm just going to assume it's more chopped consolidation. But if there's ever an argument to be made for a pullback to some sort of local levels, or, you know, a couple of red candles on the daily, I think an early sign would be a close below yesterday's low. But again, in the grand scheme of things, it's not super important. It's sort of very much zooming into local price action. I mean, this looks kind of ridiculous, but in terms of early cracks in the armor that could offer a pullback, I think this is something rather than nothing. It makes sense that we are sort of, you know, there's some congestion in this area. I think we traded to the last little consolidation before the breakdown. I don't think this is like a massive level in itself. As I said, I'm not super fond of high 30s for macro support resistance, but in terms of providing a reaction, I think that's more than adequate. So that's what we've got above us. And then below us, again, I still think the most important and also most obvious range is between 35.4 and 33.8 if this thing starts to pull back. If it doesn't, well, just more of the same, to be honest, because we've discussed what the weekly looks like. I don't think the lower timeframes add any useful amount of nuance to those views. If we look at this on the 4-hour, for example, and just delete this, you can kind of see the inside day failure is sort of visible as it's developing on the 4-hour time frame. Again, this needs the daily close to technically confirm, but we've had a spike of the high and are struggling at the low. These kinds of chop candles don't make for particularly great support resistance. So even if you were to look on the 4-hour here, I think it's reasonably aligned with our daily levels in terms of 35.4 and 33.8 as being a range, and then your standard range toolkit applies there. The earliest area to be bullish if this continues lower is the range high at 35.4, and the extremity is at 33.8, and that's it. So that's the BTC roadmap that I think is reasonable, or at least the levels that make sense for shorter term trading. But again, I wouldn't lose sight of the more important stuff, which is the weekly reclaim conflicting with the monthly resistance. I really think that stuff is more important, but our job is to trade the market today, the prices of today, not of last week, and to assess what's in front of us. And what's in front of us is a developing inside day failure. If that gets nullified, fine, maybe more chop, maybe just go up, whatever. You know, the signal's nullified, so there's really nothing to read into. If there is a deeper dip, 35.4, 33.8, I think are the most self-evident levels, and everything else I don't think warrants your attention. As far as ETH goes, there were some positive developments with the ETH ETF being announced. The ETH USD chart is stronger than before on the weekly time frame, so you'll recall from far too many streams, this 1935 level. We've already had one deviation at the level here, and now we've closed above it last week, so that's technically a valid weekly time frame breakout. The issue is ETH's underperformance has been pretty heavy. Maybe this is the breakout signal that changes it, but it also could be a local froth signal of some sort. I'm not entirely sure. I haven't spent enough time looking at it to be completely transparent. There is some local resistance as the market sort of pushed up into 2.1k, but bigger picture, I think as long as 1.9 is held, that's an okay view. It's fine to get a reaction at 2.1 as long as that reaction doesn't cause the loss of 1.9. I think if you want to be bearish this thing, below 1.9 is a really good spot to do it. You know, the breakout traders and all the ETF traders will be trapped, and then they'll probably come and clean out the range lows and look pretty rough at that point. So I'm not so fond of trading the 2.1 level. We've had some weird price action around there. There's like a double top left in or triple top, depending on the time frame you're looking at. It doesn't look particularly clean to me. And it's also still above 1.9. So if you're going to be bearish ETH, I think below 1.9 is better. Otherwise, you've got this weekly signal staring you in the face. I wouldn't read too much into this for the time being. I don't think there's anything else contextually that's missing on the daily time frame, because as always, if your high time frame levels are good, your low time frame levels will also fall in line. That's visible with the ETH daily time frame, where if you take, you know, this high, this is the deviation portion, this high, it all happens to fall around 1.9 as well. So all of that makes sense. Two useful pivots, 1.9 to 2.1, and then the breakout continuation objective, if you will, on the weekly time frame. If this signal doesn't get stuffed, I still think is a sort of gap fill of sorts back towards 2.5. So that's it. That's what makes sense on ETH. And ETHBTC, this is attempting a trend reversal of sorts. Again, part of the conservatism on ETHUSD comes from the fact that ETHBTC is into resistance here, the underside of 0.57. I think at least you want a weekly close above that level to have some sense of optimism about, at least on a multi-week time horizon with ETH relative to BTC. When you have a downtrend that's this strong and this long, the reversal signals should at least be somewhat strong to reflect the strength of the dominant trend. So dominant trend's been down, levels have been lost. I'm going to assume this is resistance till proven otherwise. I want to see a strong reclaim above 0.57, ideally, to be honest, even above 0.61, the point of breakdown, and then that would be at least some strong evidence that the week, this very long year-long downtrend is either offering a counter trend bounce or full-on reversing. But the first obstacle is 0.57, and that's in the face of us at the moment. As far as altcoins go, I mean, everything's kind of been going up. So, I mean, obviously dipping now because the market's a bit red. I don't know if BTC's moved during the course of this recording. Not really. But yeah, mixed bag on altcoins, but mostly still getting the correlation with BTC taking over. It's really dealer's choice on these. We've spoken about Link on the weekly following the breakout, and that's been really strong. We've spoken about Solana, which has surprised me to the upside. My view on this was that it would at least slow down or pull back at around $47. It hasn't done that. I think similar to ETH, this is a good weekly breakout signal. The next sort of gap fill level comes in at 78. If you're going to be bearish Sol, I'm sure there's something you can punt in 50, 60, but in terms of high conviction, high time frame levels, I think anything, a weekly close below 44 to 47, that's a much better place to be bearish than above 43, 47. This is kind of a no man's land where the early extremity, if you will, of resistance is higher, and the key fake out level is a little bit lower. So that's Solana. I don't think the daily time frame has anything to add on that. Just kind of, yeah, the Adam Cochran found his wallet meme is very much real there. For intraday traders, there's a decent extremity here at around $53, $54. If there's a failed breakout there and this really sort of reclaims and stuffs these sellers, then that would be a nice invalidation for some sort of short-term play. But the bigger levels aren't quite there. Just mapping that out. You know, if you have an asset that's very strong, it's worth mapping out the local range low levels. And if those get faked out, at least you have an invalidation and some sort of signal to go for, even if the market doesn't come all the way back to the high time frame levels. Other altcoins I really haven't been paying a ton of attention to, mostly been focused on BTC and ETH. But if you've been trend trading them, you've been doing very well because most of the stuff looks like this, even on the less impressive altcoins. There comes a point, of course, where you need to sort of rebalance or take profit or rotate or whatever. And I put out a tweet earlier today which talked about trading trending conditions. That's a mouthful. And there was some commentary there on altcoin rotations and using BTC and ETH dips to time them. I won't repeat that here just to keep the video short, but go read my most recent tweet. I think they'll have some useful information that I promised to share in one of the earlier episodes. That's really all that I've got to talk about. There's also a lot of discussion about altcoin funding rates being elevated, and the same for BTC. I think that observation is true. I think if the market is sufficiently bullish, the baseline rate should get at least mentally repriced, that there will be some premium at all times baked into the perps, which I think is fine. When it's not fine is if funding stays elevated, but price doesn't reflect it, because those high funding longs are paying to be long, and that can add up, especially if they're long BTC and then long a bunch of alts, which also have high, even higher funding rates, and they've got multiple positions at the same time, paying those funding rates every, interval. That can really eat into your margin. So to some extent, high funding from the longs point of view is an expectation of upside, but also it's also implicitly an expectation of volatility, because if they're paying a lot in funding, but their P&L isn't going up and the market isn't moving, then their liquidation point moves up as the funding payments eat into their margin, and it's a bit of a tricky position. So high funding longs are by definition on borrowed time, at least most of them and most of the aggressive ones. So it's not that high funding on its own is bad, it's high funding if the market doesn't move as bad, because it's like a ticking time bomb, essentially. So it's no problem. High funding isn't the issue per se. It becomes an issue if price doesn't reflect the expensive cost of being long, essentially. I also retweeted on my Twitter my thread on funding rates, or my long post or whatever. So I think, honestly, I guess this whole video is just a shill to go read my tweets, because there's one on trending conditions, and I also retweeted earlier today at the time of recording one on funding rates. So if you go read those, I think you'll be better off, or maybe you won't be, but if you enjoy them, they're there for you. That's all from me. Thank you for watching the show. Appreciate Woo for supporting us, especially in these market conditions. If you want to support the show directly, check them out via the links in the description, or don't. It's your life. And yeah, have a wonderful week, and see you again.